Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the earnings special edition where our focus will be on the Ceat numbers that have just come out. Remember, it's been a mixed bag for the company this time around. The consolidated net profit has declined by 41.4% in the September quarter to about 121.9 odd crore rupees. But it's the revenues that have gone up by 8% to 3,305 odd crore rupees as well. At the EBITDA level, we've seen a dip of another 20.6% to 362 odd crore rupees in the second quarter. What we've also seen is that the margins have now stood at 11% in this reported quarter compared to 14.9% in the corresponding period in the previous fiscal. To detail for us what have been the key pressure points in this earnings quarter and what is the outlook going forward, I'm now joined by the top management of the company. Mr. Arnab Banerjee, the MD and the CEO of Ceat, is now joining in to take some questions. Warm welcome to you, sir. Thank you so much for taking the time out. Could you begin by helping us understand what have been the key factors that have actually led to some downward pressure on the bottom line for you in this quarter as well as on the margins? Has it just been limited to the continued rise in the input and the raw material prices, or have there been other factors that have added on to the pressure this time, sir?
Yeah, so quarter one was 12%. So sequentially, if you see the margins have come down, EBITDA margins have come down from 12 to 11.1. Yeah. And there's been a drop in gross margins from 39 to 37.5 standalone basis. So we are going through an unprecedented upcycle in raw material cost led by natural rubber in India. So natural rubber in India and natural rubber from import landed costs never used to vary for between themselves. They used to vary between 5 to 10 rupees per kg. Not only did natural rubber prices go up to a 15-year high in India, but it had variance with international prices by more than 50 rupees a kg. This was not anticipated. It is unprecedented, and hopefully will not happen again in future. So the overall basket of raw material went up in quarter one over quarter four by about 4 to 5%, and again in quarter two over quarter one by about 6%. So that was a steep increase in too short a time span, and we were not able to pass on the full impact to the finished good customers, which is what led to the shrinkage in margin. And as we speak, the quarter three growth rate of raw material prices appear to be cooling off. It may still grow by about 1.5–2% over quarter two, and then ease off in quarter four finally as the tapping season comes in and more natural rubber becomes available.
Okay, so could you also tell us what is the average price been at for this quarter for rubber, sir, natural rubber, and what is the price that you anticipate since you're already expecting a cool off in the second half? So what can we anticipate?
So the peak price went up to 250 rupees per kg and more than that in Q2, but it is now cooled off to just around 200 or slightly below. On the other hand, the international rubber prices have jumped by about 18% over Q2, but the gap between the two has narrowed between 5 to 10 rupees per kg, which is normal. So in the overall mix, we also have crude derivatives, right? So crude has been benign. It is around $73, $74, $75. The pass-through to crude derivatives, which we consumed, for example, synthetic rubber, carbon black, fabric, etc., the pass-through is going to happen as we go forward. So that part of the raw material basket should also come down. So we should see flattening or tapering of the growth of prices in quarter three and finally easing off in quarter four, as I mentioned before.
Okay. So, like you mentioned, that while you have not been able to pass on the full, rise in prices through your price hikes, but you have taken some price hike. Could you detail for us up until the first half, what has been the price hike that has been taken by you? And going forward, would you continue at this pace or even higher?
So it's a competitive market in replacement, and in OEM, the price hikes come with a lag of 1 quarter. So, and most of it is indexed, a little bit negotiated. So we will get a good price hike again in quarter three over quarter two. We got quarter two over quarter one, but it comes with 1 quarter lag. So when the prices of raw material go up steeply, it impacts the margin in a big way. Replacement has been competitive. We have been taking hefty price hike across categories. Even on 1st October, we took a very strong price hike in passenger cars category and in truck bus radial category. But we still have to take some more, and more are planned in the month of October itself. We will evaluate and see if we can bridge the gap during this quarter in November and December. In international markets, the pass-through has been weak because when the domestic natural rubber prices went up, it was not really relatable for the international customers because the international natural rubber prices were stable. But now the international prices are moving up. So I think we'll get some opportunity to raise prices in international markets as well in Q3 and Q4.
Okay. Sir, also do tell us about the overall demand in the auto sector. Why I'm asking this is that you are in absolutely the closest to help us understand what is the real picture on the ground right now. What we are given to understand from all the earnings that are coming from the two-wheeler makers like Bajaj Auto has already hinted at a muted festive demand. It's just about 1 or 2% higher than last year. What is your overall sense in the in demand on ground right now? And do you also see this trend of slowdown continuing? What would that mean for you overall, since you had penciled in a volume growth in double digits? Will you be able to maintain that looking at this muted demand and the slowdown that we are looking at right now in the auto space?
Yeah, so let me explain. When you talk about auto space, you're talking about the OEMs, the vehicle sale demand. Now, that is only a small part of our business when we supply to the OEMs. For us, it is about 28 to 30%. The balance 70% is replacement demand and international business demand. The replacement demand is much more robust. The truck bus radial segment, entire truck bus segment is growing at good single digit. The two-wheeler segment is growing at good single digit, almost double digit. The passenger segment is also growing well. So the replacement demand is much more robust, and there is a market share game also that we play out there. We are market leaders in two-wheeler. We are a strong number 3 in four-wheeler, and we intend to be number 1 in four-wheeler tires also in the next 3 years. We are a small player in truck bus radial. However, we are gaining share in truck bus radial also, though we are in single digit. So replacement market game plan is completely different. And international business is a focus area for us, especially in the US. We have launched truck bus radial and passenger radials. Europe is growing strongly for us, and Latin America, led by Brazil, is also a strong market for us. So when we talk about double-digit growth for Ceat, it's a mix of the whole thing. And in OEM also, though the market is tepid, we believe that we will grow heavily as compared to first half in the second half because of the visibility of vehicles that are going to be fitted with Ceat as the approvals come in, as the shares go up. So in all 3 segments, the growth should be robust in second half and in Q3 as well.
Okay. Sir, give us a little bit of understanding also on the exports growth in the current quarter. I believe you had also articulated earlier that you wish to expand it going forward from here. What is the kind of strategy that we can understand from you going forward from here on the export side?
Yeah. So export growth has been double digit in Q2. It could have been much better had it not been hampered by container availability issue in Q2. And the Red Sea, triggered by the Red Sea, and there was a huge number of containers which were blocked between the China-US route. That is easing out now. And the Red Sea issue also flared up the ocean freight rates, which ate into our margins. Those rates are also cooling off, though they're still higher than the pre-crisis situation. So when things normalize, our order base is very strong. When things normalize, we will be able to ship out our containers much more frequently on time. And also the dent in our margins will get repaired. So from the fundamentals of network, product feedback from customers, product approvals by the magazines. For example, in Germany, the magazines rate the tires. We are getting very good ratings. So the fundamentals are in place, but there are some hiccups as I described. As they ease off, we will see very strong growth in exports for Ceat.
Okay. So on the margins outlook now, since we have seen the pressure building up, it's now come down to 11.1% like you pointed out. Is this the bottom? Will you see improvement from here on? And what do you end FY25 with? And as compared to FY24, what do we anticipate on the margins? Will there be a slowdown?
Well, FY24 margins are known to you, and we have seen a downward graph, Q1 being 12, Q2 being 11.1 in standalone. As I mentioned, the rate of growth of raw material prices will taper in Q3, but Q3 raw material prices are still expected to be inflationary to the extent of 1.5 to 2%. We may see easing off in Q4. Normally, when raw material prices cool off, our margins tend to expand to a normal gross margins of around 41 to 42%. Right now, we're at about 37.5%. So we expect that to happen gradually over the quarters. I'm talking of gross margin. It will depend on our ability to take price hike in the market as the raw material growth tapers off. Because as I mentioned, so far the price hikes have been inadequate, and that will depend on the competitive situation also. So difficult to predict. But the good news is that the raw material price growth is tapering off.
Okay. So also help us understand a little bit as far as the EV space is concerned. You have been providing tires for that space as well. What is the overall constitution now of the EV space right there? Going forward, how are you seeing things change?
Well, the new vehicle wise, I think scooters is the segment where EVs have really taken off. About more than 20% of the new scooters being launched are electric. In the car space, there is also hybrid. So between hybrid and electric, I think it's crossed 5%. So at this time, the game is primarily supplying to the OEMs who are launching electric vehicles very aggressively. So we have a good presence and relationship with most of the OEMs. We have invested in R&D and technology to give absolutely world-class EV tires. Also for truck bus radial. And we have a good opening share around 30%, 25 to 30%, both in two-wheelers and four-wheelers. As far as EVs are concerned in OEMs, the replacement play will come with a lag. And so the most relevant thing is now how much share we've got in the OEMs.
Okay. So in the end, if you help us understand, for FY25, your growth projections on the revenue growth side, keeping in mind that there have been hikes, price hikes from your end, there could be continued price hikes going forward from here, and the overall volume growth picture that we can expect for FY25.
I had been maintaining that we would still be gunning for double-digit growth. So that has not changed internally. And we expect half two to be better in terms of growth than half one. So we will stay with that journey of aiming for a double-digit volume growth for the overall year, definitely in half two.
Okay, well, all the best to you, sir, for the upcoming quarters. Thank you so much for sparing the time to help us understand these quarterly earnings. And always a pleasure to host you on Business Today Television. We'll be catching you very soon with you to understand more deeper trends right there. Thank you so much.
Thank you.
All right, viewers, we'll wrap it up at that. This special conversation with Ceat management. You heard from the management the key factors that have been, putting some pressure on the margins front and the bottom line as well. Things look up, start or begin to look up from the second half itself. Q3 could still be under pressure, but Q4 is when large part of the recovery could happen right there. And the management is continuing to be penciling in that growth projection of double digits as far as the revenue is concerned going forward from here, despite all the hiccups that have occurred thus far in this space in terms of the input and the raw material prices right there. We'll leave you at that, but do stay tuned on to Business Today Television. There'll be a whole host of interesting conversations with top managements of various companies that are reporting their numbers in Q2. Stay tuned.
However, the Agri Mobile Congress Business Today Television's rolling coverage is underway, and of course, I am at KPMG's stall, and I'm joined by an expert a partner who's actually, will give us brief insights and deep insights on what really is the situation on the ground when it comes to telecom and, of course, other sectors as well. Thank you so much, Mr. Tuteja, for speaking to us. First of all, the Prime Minister inaugurated the IMC as usual, and the